None of VPN Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPN Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPN Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPN Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good afternoon / good morning, everyone. For Mitch is in a different time zone. He's out on the East Coast. And,
that's right.
I'm still where I'm supposed to be, out here in the heat in Scottsdale, Arizona. Anyway, we're trying to show this morning, my time anyway, we are thinking that it's a bandwidth issue with the issues that we've had in the afternoon session. So hopefully this will work out, because we never have any problems with the market thunder. So we're doing it in the same time slot and trying to do our best to get that to be the case. So today is a continuing saga of the Process Warriors, which is really understanding how to implement different types of processes. And we're still trying to get, I feel like we're still at the it may sound technical, but I feel like we're still broad-based, kind of still trying to paint the picture of what we'd like to see everybody doing. We have many of you are doing most of these things pretty close to what we have going, but we want to continue on and try to develop a pretty good overview of what you're doing. Hopefully, if you don't, this is something you could watch a couple times, some of these. I think 2 sessions ago, I feel like that was one of our better Process Warriors that we had anyway. And anyway, I think this is going to be hopefully fun today, right, Mitch? We're going to have fun, right?
Let's hope so.
Yeah, okay. Well, why don't you go ahead and drive and start off the process, and we'll interact with how things are going here.
All right. So where we're at right now, we're still talking about some of the initial concepts when it comes to building out successful portfolios. And the big thing that we're going to be discussing today is how to properly evaluate and validate your portfolio. So some of these elements that we're going to be talking about, we've covered bits and pieces of it so far, and this is sort of where we've gotten to at this point. We started off with building initial stock screen portfolio. We showed you some of the concepts around that. Talked about how to screen that, how to select the right basket, how to maintain it, some of the considerations for maintaining it, and then last time when we got together, we talked about how to properly price it. From here, what we're going to start doing is we're going to start moving on to the next stages, which is making sure that you've properly validated and gone through the steps of reviewing the portfolio before going live. And what we're also going to be covering today is more of the elements, especially around indexes or mutual fund based strategies. So that's what we're going to be going to from here. So bear with me 1 second.
Sorry about that. I grabbed the mouse from you.
That's all right. For those of you that don't know, it's funny. I'm on the East Coast, but I'm controlling the computer over in Phoenix. So really, we're going to spend a lot of time, I think, just having some conversations today, as well as interacting with the 2.0 system. But when it comes time to evaluate a portfolio, one of the first questions that you need to ask yourself is, did you build what you had intended? When you construct a portfolio, you can have a lot of these different ideas of what you'd like to do. But when all is said and done, did you actually succeed in doing what you had hoped to accomplish? And some of the things that you need to take a look at are things as simple as, are you actually deploying capital the way that you had it intended? So one of the things we're going to take a look at in a second within 2.0 is looking again at that investment histogram, showing you how a portfolio has deployed capital in and out of the market, and some considerations when it comes to the portfolio's construction as well as the components within it. So that way you can see if you did properly make use of capital, and if it's working as well. One of the other things we're also going to do is take a look at it and see, does this actually fit your business? Does this fit with what you're trying to do within the overall scheme of things within your practice? And then also one of the questions we need to ask is, how much risk are you taking to make the returns of the portfolio? So at that point, do you want to pull up 2.0, Bob, and we can begin to start navigating through some of these high-level points in this?
Right. Okay. Yeah, just give me 1 second here, and
Sure.
I will do just that. I have one issue with something I'm fixing. So let's go ahead and. So you want to go to 2.0 already? Huh?
I do.
Okay.
Just throwing you.
Yeah, I wasn't ready for that. Here we go.
All right. So one of the things that I wanted to start with, and we'll see this really quickly. When you construct a portfolio, and I created a number of different portfolios that we're going to be going through and interacting with today. One of them I just whipped together is this broad markets portfolio. And one of the things I just want to highlight for you, this sort of keys in off of what we discussed last time, is when you construct a portfolio, if you don't properly review it as far as the components of it, the use of capital, and the things like the days invested, you might see a chart like this. And so if nothing else, I just wanted to key in on this portfolio to show you this right here. When you construct a portfolio, if you happen to see a line that's either overly flat or just slightly curved, or does one of these stair-stepping things, right away whenever we see a portfolio like this, we see that portfolio was constructed with an earlier inception date than actually was traded within, then the securities within the portfolio were actually traded. So what you see here on this equity curve, and we'll go through this in a second, is you see the inception date of the portfolio where we started here, and it didn't go anywhere. And the reason for that is because at the portfolio's inception, all of the securities, or the vast majority of these, hadn't either existed or hadn't been traded yet. So as time goes on, you're going to see these stair steps because there's a management fee coming out of this. If we didn't have any sort of management fee in place, it would just be completely flat, or it might show a slight curve.
Yeah, actually it would be a curve up, because whenever, and this is actually a good point, because some of you are putting money markets instruments into your portfolios to try to generate interest on cash, and you don't have to do that. We actually do that for you. We generate what would be like a money market type return on any cash that's there. So there's always interest being generated. It's not much anymore, but it is there, and we use basically a 30-day T-bill, which is equal to most of the funds. Now, there are some things you might be able to generate it, but the difference between 0.07 and 0.09 or 1 isn't going to be material to what you're doing. And the reality is, in the modeling side, you don't need to worry about that, because your custodian and what you actually do with that cash, you can do other things with the cash that will be fine to do. And then when you redeploy that capital, whatever is generated will actually get redeployed. So sorry, Mitch, I just wanted to add that in while we're at that point. No,
that's perfect. That's exactly what I want to discuss is, and some advisors, and we'll get into this in a little bit, what they'll do is they'll see something like this and they'll say, well, I'd rather, instead of be earning 0.001%, I'd rather have some other investment vehicle. What they'll do is they'll construct that money market fund, or maybe a particular bond fund in the portfolio. They're viewing it as something as a cash proxy. But what that ends up happening is it skews the performance of the portfolio than really what you're intending to do. One of the other things that we want to see, now that we've looked at the equity curve of this, I also want to show you, we had discussed the investment histogram. And for those of you that don't already use it or aren't familiar with it, the way to access that is by clicking on the trade profile link over here on the left-hand side beneath portfolio reports. Now, when you get to this page, you'll be able to see some of the elements that we used last week, the average trades per week, the average days long within a portfolio. And this gives you some pretty good metrics when it comes to looking at the activity within the portfolio. You can see how it is that you're making use of capital in the sense of how many trades that you're going through in a given week, especially after we count for standard deviation, so we can see, and when we start to move off the more extreme times, what this typically would look like. And then what you could also see is with these portfolios, typically how long we're holding on to these securities at a time. We get questions pretty frequently from advisors wanting to know, well, how long can I expect to be holding one of these positions, or how active is the strategy going to be? And this gives you a nice high-level view to see how this is working within the portfolio.
Yeah.
But
go ahead.
Go on.
No, you're on a flow conscious. I have something I want to add when you're done. Go ahead.
All right. As we saw with that equity curve, though, we saw that there was those stair-stepping returns when it comes to the equity going the wrong way. We're walking down the stairs as opposed to walking up the stairs. If we click on that investment histogram, one of the things that you're going to see right away.
Let me fix that for you.
Sure. One of the things you're going to see right away on this chart, we discussed this last time, but I wanted to put together a really good snapshot of what this may look like if you didn't properly construct the portfolio. And here you see that the bar over here on the left-hand side for zero, number of days that we were at 0% exposure within the market was by far the largest. And then we go quite a while before we get to some other days. And what that shows us is there was too significant of a portion of time.
Well, what it was 660 days, was about 3 years.
Right, where we weren't doing anything other than taking management fees on this.
Yeah, like 200 trading days a year, so it's pretty significant. It's going to impact your back test, no doubt.
Right. Now, we'll talk about in a few minutes about how to fix this and how to actually construct this properly. But I just wanted to give you a good, clean shot of something that shouldn't you shouldn't see within the portfolio unless you've done something wrong. And what I mean by that is you've either created a portfolio with a bunch of holdings, especially ETFs are a common occurrence. That's why we're going to be digging into that a little bit today, where you create an inception date of the portfolio long before the actual trade date of the ETFs. Now, Bob, you wanted to talk a little bit more about this trade profile.
Yeah, there's a couple of things here. This is actually a bad one to talk about. I guess there's not much here. Average trades per week is 0.20, and this is the beauty, in my opinion anyway, of what VPM can do, is you can actually quantify a lot of what's going to go on in your portfolios as long as you're willing to stay the line in the process. And what that means is that right now, this particular build that we have up here is a 0.20. So you take 0.20 times 52 weeks, and that'll tell you how many trades you have. So it's going to be 10, 12 trades, I guess, on this portfolio. So whenever you see a 1 point something, you're going to be looking at 60, 70 trades a year. This is one of the reasons why when we're building equity strategies, but we're asking you to keep a reasonable amount of number because of the turnover. Is you can get, there's less is better to a point, but this is a place where you can see especially when we're at the stage we're at now, is we're building and evaluating what we have, and that's a good place to look. The other thing you can see is the average positions per day, and there's not very much in this one. It was purposely built to not look good, I guess.
Right.
And so the point of that is that you can see exactly what's going on. You can see in the standard deviation. You can see the min-max. So this isn't a very good profile, and I'll maybe touch on that later. So why don't we move on? Now, you're going to just stay here, or we're going back to the PowerPoint?
We're going to go back to the PowerPoint. Yeah, we're going to be jumping back and around. So
all right.
A couple different elements where
I'm confused. I hope you folks aren't anyway. So.
All right, so let's go back over to the PowerPoint if you could, Bob.
Here, I'll go ahead and do that. Yeah, I grabbed it away from you, so alrighty.
So, right away, we had already answered that question. Are we making good use of capital? And this fictitious portfolio that I constructed, we see that we weren't making very good use of capital in it. One of the other questions that you need to ask is, now that you've constructed it, does it really fit your business? And when it comes to building out the portfolios within your practice, we've talked about this a number of times, of building a select number of portfolios that you could utilize across your entire book of business. And one of the things that you may need to do is when you take a look at your book of business, maybe you find that there are a couple strategies that you are using across the board, but there may be a few more exceptions that aren't used as commonly. And so you need to ask yourself, now that you've constructed a portfolio to address this, is this something that you want to use going forward? Does this still make sense for your practice? Or do you want to transition segments of your book of business to some of these more mainstream or common strategies that you're using across the board? Or maybe you need to construct some portfolios to attract the type of clients that you'd like to be working with.
Yeah, maybe I got confused during that, so I'm going to try
Sorry.
to. No, it's okay. I just want to make sure is that one of the things that I don't think we haven't touched on yet, this may be the next show or sometime soon, is really combining strategies to articulate what you're trying to do for clients within the practice. So probably should probably should stick with just the actual portfolio here, because when you start talking about blending and all that, and this particular strategy that you're building, if you recall, we went through and we set up a style statement, or what the purpose of the portfolio was, and then we made sure we've already done steps leading up to this point where we've already made sure that the constituents that are inside of the portfolio are actually matching from suitability and goals, and whether it's a alternative strategy or if it's a pure equity like a global equity 4, where it's a global equity strategy, or maybe an all-weather where it's got different style boxes, large, mid, and small style boxes with bonds mixed in, or none of the above, whatever it is that you built. You just want to make sure those constituents will match in pretty good. And then once you've got this, and probably next meeting or so, we'll be able to go in and start talking about combining, maybe bring up the combine tool and some other things to start to build the practice out from a suitability standpoint. From right now, this is a single strategy that is going to do a segment, and in some cases, depending on what it is, it can actually run an entire 100% of a particular strategy, at least from the equity exposure side of what you're doing.
Yeah, and that's like what we talked about last week, or a couple of weeks ago, a couple sessions ago, the all-in-one type strategies, where you've constructed everything that you need within the strategy just to be able to deploy it and have it run a portion of the business. Yep. One of the other things that you need to do when you construct a portfolio is evaluate, how much risk are you taking to make these returns? It's every now and then we'll see an advisor add in a bunch of obscure positions, or maybe they're adding in some additional alternatives, especially trying to generate additional returns, but it doesn't necessarily have the impact that they were looking for. And so then the next things that we want to really dig into is the expectations. Making sure that you, as the advisor, have the right expectations, that you could then broadcast that to your client base so that they have the right expectations. And there's a couple of different ways you can do that. One of the common things that gets used within the industry, of course, is the annual returns. They look at a rolling, or a year-by-year snapshot. And one of the issues with that is a year like 2011, where you see that the year for the S&P 500, it ended flat. As far as the market was concerned, from point to point for that year, the market was completely flat. The problem is that doesn't give you a good expectation as to what actually took place within that year, and what you would expect to see or could see again in the future for a strategy like that, like the S&P 500. We had discussed this internally. Bob and I had a bet where we were trying to remember exactly what the range was for the S&P 500 that year. And actually what had happened is the market had gone up about 10-12%, and then it had fallen apart. And so within that year, there was a 20 percentage point swing that took place. But if too much time goes on, which really it already has, where a lot of advisors, they look back, they might look at the calendar year returns of a year like 2011, and they just brush it off because the market ended flat. And so they completely discount what actually took place that year, the volatility, the pullback that and drawdowns that took place that year, and they just move on and think, well, it was just a flat year.
Yeah. And one of the things I always ask is the fact that it was flat, does that reflect how much risk there was in that particular window of time? And the answer is absolutely not. I think the bet was, I thought it was down 27, and Mitch actually looked it up, and I think it was 22 or something.
Yeah, I think you thought it was 30 or somewhere around there. I thought it was around 20, somewhere around there.
I think it was 28.
But I was unwilling to make the bet.
Yeah, so he looked up and got the answer on Google, and then and
then I regretted it. So because I hadn't taken the bet.
Yeah.
But so one of the things that we do within 2.0 is we actually show you the rolling returns. So within a portfolio, you can actually see what the best and the worst 12-year period, or 12 months.
I feel like we should be on 2.0 now, huh?
All right, let's go ahead and pull that up. Like I said, we're going to be jumping back and forth today. And what we'll do, in this case, we'll actually pull up the PPG 500. I do have that subscribed on this login. So if you just want to grab one of those.
And yeah, and I'm going to get rid of us here 1 second here.
All right.
So we have a little more screen to work with. Okay. All
right. So quite often what a lot of advisors see when they pull up a portfolio or they click on it, it goes to this summary page. And it's a nice snapshot of the returns when it comes to month by month, which you see here in a particular year, particular month. You can see what actually took place in that given time period. You can see what took place when all was said and done in the annual returns. But what we would like to do is dig into that a little bit more and talk about, well, what actually takes place within a rolling 12-month or 24-month time period. The way you do that is over here on the left-hand side, again, underneath Portfolio Reports, and the link to the right of Trade Profile, which we were just interacting with, is Performance. And when you click on that, it pulls up this segment of the portfolio's data where we can look back over the last couple of years, see some fairly recent returns when it comes to how the strategy is performed. And this is in a rolling 12-month time period. So you can see month by month in this table right here, how that strategy had performed over the last 12 months. So in other words, if we look at this top left box right here where it says January 2010, if a client had come on board in January 2009, their first annual review in January 2010, you would have been sharing with them the news that they were up 24.743%. So what we've done by having this type of analysis at hand is we've been able to provide you with some fairly consistent expectations as far as over the life of this portfolio. With this chart right here, you can see how much of the time has that rolling 12 months been positive or been negative. So you can see over the different market cycles, depending on how far back the portfolio goes, you can see how much of the time has it been a positive return or a negative return, and also how large of a gain or a loss you would see with any given 12-month time period. So in this case, you see that the best, it's a little hard to see on this. Can you zoom out a little bit, Bob? Just want to get the dates, or at least the years at the bottom.
Sure.
You can see here that the best
I'm trying to get
period,
it right. There we go.
There we go.
Sorry.
Was just over 40% back in 2004, if I'm reading this right. So the best 12-month time period that we've had was actually all the way back in 2004. More recently, we had it again in 2010, which makes sense after the lows of getting in on this portfolio in 2009. We got up around 36% from spring of 2009 to 2010. And you can see that just like the market goes, this portfolio is going to have ebbs and flows. You're going to see some times where there's going to be negative returns. But now we can see, well, how much of the time does that have a negative return versus a positive, and what the magnitude or the scale of that is. So then we could refer to something like a benchmark, which we do often on the fact sheets, where you can see, well, if the best time period in this, which we highlight on this data table, the best return over a 12-month period was a gain of 42%. The worst was actually a loss of 20%. Now you compare this, again, this is the PPG 500, so it's using the same components of the S&P 500, but it's using our allocation factor, it's using our buy and sell logic in place. This is I believe half of the worst 12 months time period when it comes to the market, which was somewhere around 42% if I recall, over a time period. But the best is almost identical to what the S&P 500 has in this case. And then right beneath that, you also see what the average is. So if you were to pull up this portfolio in an average, it'd be 6.5%. And you can see, at least in the recent history, how that has performed year by year as far as these rolling returns, month by month as well. And then further down on the page, you'll see a rolling 24-month time period. So this is also, if the client comes in and they have that first 12 months review, and you share the news with them that they were down, let's say 20%, another year goes by and they come in at worst, that over 24 months or 2 years, they've only been down 20%. Whereas at best, they were up 53%. So you can see this chart has spent much more time on the positive side as opposed to the negative side. And there was that time period, where we were largely out of the market, waiting for that opportunity to get back in. So you can see that in the 2009 to 2010 time period is really where we spent the brunt of the time out of the market. We had taken some losses. We were waiting for those to redeploy assets into these positions, and then we could start participating in these gains. You can see that since then, there's a lot of green in place when it comes to a 24-month time period.
Yeah, the point, just to get to summarize what we're really talking about here, is really what you can develop is an understanding of the rolling return, so what a client's likely to expect, and when you're building a portfolio, what you're likely to see out of the process. So you're looking at typically, I'll go back to just toggle down just a little bit to the annual. Your average is 6.5, so the average client that walks in the door is going to make 6.5, but the standard deviation is 12. So that's what, -6, -5.5, plus 18, 19. So, but the average is going to be 6.5 on this portfolio, and this is obviously a 500 stock portfolio, so highly diversified, and that's what you're looking for. We didn't do a quick comparison, but I'll do that here real quick. Is you can see by doing a lousy 6.5% per year on average, you managed to way over double the money. You went from, in 2000, from $10 NAV to $23 plus. So you're looking at there's something to be said about compounded rate of returns, and that's what we're trying to do, is flatten out the downside and be able to generate across any valley or any peak a consistent return over time. That's actually how money management works. It doesn't work by somehow magically beating the average. You end up beating it every year, but you don't beat it in the way that you think you beat it. It's a tortoise and hare story. I did 6.5, and market did all the ups and downs. Guess what? I won the race, and that's really one of the things I think is it's important to understand, because that's where I think clients, the misrepresentation of what they should see. We've seen over the years people using the Advance and Protect, I guess, brand, if they will, and what they do is, well, when the market goes up, we go up. When it goes down, we don't, and that's not exactly true. And there is some relative risk in all markets and all strategies, no matter what you're doing, whether it's Monte Carlo, VPM, doing MPT, any type of allocation strategy. Nothing's a straight line, and what you're ultimately just trying to do is flatten it out and generate this return over time. So I feel like we should be back at the PowerPoint, so I'm going there.
Okay, sounds good.
These sessions, they seem like a long time, but guess what? Time goes faster than you think. We're halfway through the meeting. I know there's a lot to talk about yet.
Yep. So now here's this sort of segues to, now that we've seen what this portfolio has done as far as, since the back test or the history in the case of these premier portfolios, how do you present this thing? What what do you do? And this is actually one of the more commonly asked things when an advisor comes on board. Of course, they want to get a handle of how to use the system, how to navigate, create their portfolios, and then they're faced with the challenge of actually presenting it or marketing it. And one of the things that you, of course, need to do with every single portfolio is begin by saying, well, who's it for? Who is your target audience on this? Did you come up with a lot of great ideas or come up with a lot of different strategies, but find that you have no internal client base to go after? So does that mean that you're going to have to be, having this segment of the strategies that you use maybe for prospects, or is this, for your core heart book of business?
Well, I would argue if you've done what we said in the last 3 shows, you wouldn't be asking that question at all.
That's right.
You built your strategy. You looked at, your first thing you did was review your practice. Number 2 is figure out who the customers are, what you needed to build, what constituents went into the strategy that ultimately got you to this point of the review. So this question you should have already had done, I would think. So
I would hope so.
Yeah. So what's in it? That's also done. What does it do? That should be done, I think, right?
Right. Well, and it's when it comes to presenting it, these are the questions that you need to be able to answer so that you can then get it to your clients.
So who it's for is easy because you wouldn't be presenting it to someone that it wasn't for, right? You would already know.
I would hope so.
I'm sorry. I have to. Sometimes I have to bust Mitch's chops just to. But I think it's important because I think it is, and part of the presentation process is going back to what we were just talking about, is understanding what the expected returns are. So let's say it's 6.5. Let's use that example we were just doing. That's I don't want to present. I guess going to the point of well, when the market goes up, we participate. When the market goes down, we don't. And the customer goes, oh, hey, that sounds good. I like that. That sounds really good. I don't like losing money. And that's true to a point, but not true. And that's why these expectations and looking at the drawdowns and things, we didn't go there a lot, but some of those drawdowns are pretty important also in that rolling return, because a lot of times the drawdown. Now I want to go back to 2.0. The drawdown is important because it tells you, like, the average drawdown may only be 2.345%. So what does that mean? That means that the average drop in value from a peak to valley is 2.3% or whatever that number is before it makes the next new high in the next cycle. Doesn't mean it's the maximum drawdown. It's the average drawdown or the number. So most of the time, so this is a great time. Let's say you got a new client walking in the door and your current drawdown is pretty much the same as what it is, or it's exceeded the average drawdown. Man, you almost want to double buy everything, because what it means is that most of the risk of the average risk in that portfolio is out of it right now. So my guess is, if you look at a lot of your portfolios right now, just because of this choppy year we've had so far, I bet you a lot of your portfolios are sitting right there from an equity curve. Everybody worries about how much is invested and all that. If you look at the equity curve, that's what you're generating through the process. If you look at that and you start to match, say, wait a minute, it's down 2.5%. We're down 3.4 right now. I've got a 1.4 average edge over the next high. So you're going to generate additional alpha from that high to the next high. And, that gets me excited when I see that, because that's the opportunity. It's not about, well, how much do we have deployed? It's about, where's the equity curve on a relative basis from where the last peak to the valley is, and what is that average? So that gives me the ability to confidently deploy this capital, match up the models, stop worrying about all the stuff that you can't control anyway. So if you don't match them, then you're going to underperform and the market goes up because you don't have enough. And if you do match them, it's going to be whatever it's going to be, and you still have the sell discipline and all that. But looking at that drawdown number is huge, because that gives you the edge of at least understanding that you're at or below the average drawdown, and that's a great point to deploy new capital. And whether it's a brand new customer or a customer who's coming in with with a tranche of capital that they want to add to their account, those are great moments in time to pay attention to.
Well, actually, that's a good side question, or I guess you've just referred to the drawdowns. Let's real quick. Can you highlight in 2.0 where they can find this on the portfolios?
Yeah.
Because it was on the screen, we didn't get a chance to show it. So maybe you could show this portfolio, and we could grab a couple of the other premier portfolio and show you, where we're at when it comes to the drawdown.
Yes. So here's the average drawdown is 2.1%. If we look at the current summary, we can see that this particular is, let's see if there's a percent drawdown, 1.385. Right here, we're see if I haven't used my whiteboard yet today, so this will give me opportunity to do that. But I'll just draw an arrow to this where it says current market drawdown, and this is 54 days. Last high was made on 3/6. One of the things that'd be nice to know, and we don't have this stat, is what's the average days of a drawdown would be nice. I don't think we have that stat. We might. I'm not sure.
I think we might have it on the fact sheets.
It might be on.
We have it on
yes,
this, though.
I think it's on the fact sheets and not on this. So if you're using a PPG 500, which means you have a $10 million account, which is nice.
That's nice.
But the any other strategies that we have, global equities, any of the ones that they're stat sheets on, you can see this. But regardless of that, it is 1.3 right now. My bet is just a couple weeks ago when the market was off a little bit more. I'm looking at the equity curve on this. It was probably close to that 2% number. Now it's working its way back to make a new high, and we'll see how long that goes on. But
why don't you grab let's grab something like the Global Equity Strategy 4, because that's a commonly used portfolio. So we can just compare that to the something like the PPG 500 when it comes to the drawdowns.
Okay, so let's do that. Yeah, so we'll go ahead to performance. We don't have to do an overlay of this, but right now, average drawdown 2.2%. Going back to the summary page then, and looking at that, we're 1.59% right now off the last high. So the fact is that the strategy's down 1.5%. It's off its high, which was made on 12/31. So you're looking at stock market. If you look at the small cap index, you're doing lots better. If you're looking, depending on what you're comparing to, you're doing better. But you're also looking at a year that's been pretty flat. But meanwhile, we're only 1.5% off the last high, which was the last equity high. And one of the things that I talk a lot about and this will be very quick for me to bring this up, is when you're looking at the equity curve, the whole plan in VPM is stair-stepping the equity. And this is what we're doing. So now, that's the plan.
Right.
Move the money higher over time. It's like, you don't make money every time, but you make money over time, and you do it by controlling risks. And so when you see areas like, trying to find my cursor here, when you see areas in this flat range here, which was, guess what, 2010 to 12, the markets were very choppy. VPM was in a consolidation phase, and when the trends finally caught, look what we did. We participated again. Everybody was, not everybody, but a lot of folks were disappointed because of, like Mitch was talking about earlier, 2011 we had, a negative performance. 2012 was not up to par compared to the market. But in the end, when the markets trended again, they weren't trending during those times. They were going from a peak to a valley. And when you look at the annual snapshot, it was positive. But does that reflect once again what you could have done with the market, what was realistic? In our viewpoint, no. But what happened during that time is VPM was playing a lot of protect from the standpoint of the fact that those markets did what they did in 11 and 12. There was a ton of perceived risk out there, therefore volatility. And then once this thing caught hold, we were all over it. And now we've seen where we're starting to set up potentially. If I take and clear this off real quick, that's not what I was looking for here. If we clear this up here somewhere, there's a clear button, but that's it. Of course not. Nice. That was not it at all.
I think it was right next to it, the eraser button right next to it.
Yeah, I'm not sure where I'm at now. So I am not going to save that, and then we're going to get out of there. But anyway, so we're starting a consolidation range right here that is probably the next point where we're going to consolidate the equity. So if indeed the market makes a new it fails at these new levels, we're starting to already protect some of the capital. We've taken profits on a lot of symbols, and we're seeing some reemergence of certain sectors and certain items coming in. But the bottom line is that we're in a protect mode at the moment. And from my viewpoint, we just advanced the equity from, let's see here, 250 to 320 on this account. I want to keep that money. My goal is to keep that money. Matter of fact, one of my very first mentors, Chicago Board of Trade, said to me, your job is not to worry about what the market does today, but to keep all of the profits that you can within the context of what you're trying to do in your trade. So he was trying to tell me is you've got to maintain, once you make money, you've got to keep it. You can't let it fly. So by getting out of the market, we hear a lot of, oh, we're underperforming, we don't have enough exposed and all that. And the reality is you have just the right amount exposed because you've advanced the equity, like I said, from 250 to 320. That's some 20% plus. That's a good job, because that 20%, if you did nothing for the next 3 years, guess what that works out to be? That's just about your 6% gain if you do nothing for the next 3 years. So it's all this anxiety that's created around what the market did and what we're doing, and oh my gosh, well, it's actually done exactly what it's supposed to do. I mean, when you look at this performance, I'm a little deeper in this. I got myself in a hole here I'm trying to get out of. But if you just look at and just doing it, well, this isn't a great comparison to that. But when you look at the equity, we participated as expected. You see a higher slope in this pattern as well. Let me make this bigger so we can see it. You see the higher pattern over here, if you can see between, and this gap is maintaining the value. This gap is the value gap that VPM has generated. That's the alpha over the index. And literally, and I look at this and I'm amazed. Sometimes I pinch myself, did I build this? It's, is this concept? But when you see what we protected in '08 here, and what's happened is that gap that we created by missing out has been maintained. That's the job, not to beat the index. And meanwhile, while maintaining this, like I pointed out, in by August of 2009, after the crisis, this portfolio was making all-time new highs. That didn't happen for what, 5 years on the index? We're talking, what, 4 months after the low of the market, we're already making new highs on this strategy. And so, it's all these windows of times that the questions come in and what are you doing? But when you look at this, this is what you want to do. This competes with some of the best track records on Wall Street, by the way, of the very, very smartest people out there being able to do that. You can bring up a lot of mutual funds. They don't look like this. They look like the market. So they might have added a little alpha here and there. And there are some good fund managers and good people, but they don't generate they don't generate 10 to 30 when the market went 10 to 20. There are some out there, don't get me wrong. But I'm just saying, from a strategy like this, a generic, plain vanilla strategy, this is a really, really good strategy. And there wouldn't be one of your clients that did this for the last 10 years that would be disappointed in what you've done for them.
Yeah, and I'm glad you went down this route, Bob, because it's you look at that chart. It's a great example to show you. And if you just draw that line right from the top of 2008 for the S&P 500, you can see how much time was spent trying to reclaim the equity that was lost that year. So, I mean, this is one of the things that I'll do frequently when I'm working with new advisors, just to explain what it is that we do is pull up a portfolio like a premier portfolio and then show them the length of time it took to reclaim a high watermark. And, the S&P 500 obviously is one of the more commonly used ones when it comes to benchmarks. And you can see that it wasn't until partway through last year that we finally reclaimed all that we had lost going back to 2008. Whereas an advisor that had been using something like our Global Equity Strategy 4 here, it wasn't until 2009, halfway through the year or beginning of the year, sometime in spring, that we started creating new high water marks and walking that value higher.
Yeah, and I drew some lines when Mitch was talking just to point out. He talked about the very first long line that goes on the S&P. You can see that was all the way until 2014, like 2013, before we got to that point where I put the downward arrow. That is where that occurred in VPM. Was literally August of 2009, and then I drew some arrows in between there, which was demonstrating that gap or that alpha that's been done there.
And as you're watching this, I'm hoping that if you haven't caught on by now, you'll catch on by this. What we're showing you is essentially what you should be showing your clients, or what you should be presenting when you go through the process of talking about the strategies. Talk about what goes into the portfolio, how it was constructed, and some of the common elements of it. We talk about how it's handled various different market cycles, and then you can do something like what we're doing right now as far as pulling up the performance page here, drawing lines on either a piece of paper if you want to print off this, and you can very easily print off any of these pages, but just by clicking that toggle print friendly view at the very top. Bob has clicked on it a couple times just to get that sidebar out of the way while we're talking. But when you do that, you can easily just push Control P or print at the top of your browser, and then you could print this off, and you could use this if you're sitting down with a client, you could use it as a way of illustrating things with your clients. You could also right click on the image, as Bob is doing right now, and copy it and save it to a Word document or put it in a PowerPoint presentation. We have a lot of tools available to you, and now that we've keyed in on some of the things that are important when it comes to the presentation process, you should be using this yourself as opposed to just taking out a back of the napkin and a pen and just trying to explain it that way. You should use, whether it's our website if you want to pull it up and just key in on some of these things live, interact with it. You could certainly do that. We try to white label everything, and so one of the things that we have tried to do is make it as easy as possible to get this information, this layout out of our website, so that you can put it in your own PowerPoints, your own Word documents or spreadsheets, so that you could use it with your own branding, your own logos on it, so that when you're making this presentation, you're reinforcing your own brand as opposed to our brand.
One of my favorite conversations is, our customers, they don't care about any of this stuff, and we don't want to show them that stuff because all that. But meanwhile, the mutual fund companies, who cater not to you but to the individual investor, sure do a lot of this stuff. I don't know why. Do you have any clue, Mitch? Because they just like wasting money with research departments, but they do a lot in presenting what they do, and
right.
These stats are there for a reason, and people actually do care. And some of your higher net worth people are actually pretty smart, I'm betting. They made some money. They're probably pretty smart. So I think there's more to it. We hear that, not a lot, but we hear it often enough that it's a topic that, we don't really care about this stuff. But, you really should, I think. Maybe it's, obviously if it works, it works, but what would be the difference? A lot of people we meet want to build their businesses, and they want to change and bring in elements that they don't have. Well, we're giving you the ability to do that stuff, and man, we love doing that stuff, right, Mitch? I mean, it's like it makes our day to get an advisor that really embraces and say, hey, we really want to get this brand of ours done. Get rid of all the VPM stuff and let's build it out and let's make it happen. And man, I'm excited when I see that, because I know that there's somebody there really trying to do something. Not to trounce on somebody that maybe aren't doing that, but the napkin thing works. But sometimes the not overgloss it, but there's a lot of benefits in having it there, even if the customer is nothing more than impressed that all this stuff. Maybe I don't know.
Well, yeah, and there certainly is that element to it. The other thing that as for the back of the napkin folks, the concern that I have, and this comes back from my compliance side of things, is if I find out that a client were to invest with an advisor, and I asked them, well, what does this do, or do you know how this thing works? If the client doesn't have a basic understanding, and they utter the words, well, I don't know, I just trust the advisor. Those are very dangerous words.
Yes.
I've heard advisors say that before, that the clients just trust me.
Yeah, and that's good. That's good.
That is the
but when it comes to documenting those things, and that's one of the things that I've talked about since I started this company almost 15 years ago now, is that the ability which to document what you've done. We had a conversation back in 2001, a New York Stock Exchange arbitrator, and we showed him what we could do and what kind of process we were providing to our customers. And he just kind of shook his head and he goes, you know what? He goes, the last 3 arbitrations I've been on, if they'd have had this, we'd have never, he goes, number one, we'd have never made it to arbitration because there'd have been nothing to arbitrate. He said they would have been able to document what they did, how they did it, when they did it, and why they did it. And it's game, set, match. The client, if he was explained this and presented properly, doesn't really have anything to go on. And let's face it, the only time you end up in one of those is there's some naughty being going down. Somebody did something bad, somebody lost some money, somebody didn't do what they said they were going to do. Those are things that generate arbitration cases anyway. I have never been in one, don't plan on being one. I had one of my reps get me in one, but I didn't do it. But the bottom line is that you have to have this backup, and if nothing else, in the sheets. And that's why we went through 2 meetings ago talking about building your tracking manual. We're still multitasking here, trying to come up with a format that you guys could grab. I had an old PDF I put out years ago, just some ideas and some things that you should do and things to print and all that. So we're going to revisit that, since the last time I think I visited it was like 1998 when I started the company. It wasn't quite that bad, but it was good, solid thoughts and tracking and making sure that you're doing things. So as always, Mitchell, we've had so much fun that the day is quickly sliding by on us with a few minutes to go. So I don't know, maybe some closing comments or something to trigger off this screen. I went back to the PowerPoint here to see if we can see if there's anything on the next screen to trigger anything. Yeah. I've lost sound from Mitchell here.
How about now?
Yeah, there you go.
Yeah, there we go. Sorry about that.
Muted his mic.
Muted on my end. Fat fingered that. Really what we've done is we've discussed a lot of elements. At the beginning of this, it was about stock portfolios specifically. We've then broadened this out to general portfolios, and then really where we're going to be taking this forward is now talking about the index-based assets, the ETF, the mutual fund portfolios. We ran out of time today to be able to dig into it for this part of it, but I think this is actually a good place to end for today. Is what we've already discussed, because really that applies to all strategies. But now that we're going to be going forward talking about mutual funds and ETF strategy, we can really dig into the next section of it, which is some of the common pitfalls or mistakes that advisors make when they start working with these index-based assets. and we can start talking about what a healthy portfolio, what a proper portfolio looks like when it comes to existing mutual fund or ETF strategies. We'll show you some of our premier portfolios that we've already constructed, some elements that we've seen other advisors utilize, and how you can do this successfully. So I guess that's a good teaser for next time.
Yeah, and let's just talk about this for first point, though, because we can generalize some things and set it up as well thought out versus kitchen sink. And the kitchen sink is we see advisors build an ETF strategy with 77 funds in it. And what we know is two things we know right away. They're not trading all 77 funds, running VPM as it was built to be run. They're using it as a glorified watch list, if you will. And oh, this one's a buy. Maybe we should buy some of this, and they get 3% of this and 5 of that, and it's just, I mean, it's terrible to see that. And because most of the time, if you look at our premier strategies, we've got 5, maybe 8 ETFs in a strategy. I've always said more than 12 is too many, because when you start looking at when you get traction on these different symbols, you're going to dilute the position sizing too small. So if you do a 5% allocation to something, it's laughable. I'm sorry. It's not going to do anything for your customers. It's just not going to do anything. If you make 100% on that, you're going to make 5. You lose 100%, you'll lose 5. But typically you make 20, so you're making 0.1 something to the portfolio. It really is immaterial. And the concepts that we are at least promoting is the ability which to make a more substantial bet in a particular segment with a good solid sell discipline and rotating them that way. Because in the end, it's about making returns. It's not about making, the goal isn't diversification. The goal is making money. So,
well, it's beyond just simply diversification. It happens fairly regularly. I wouldn't say it's every day, but fairly regularly. An advisor comes on board, and they'll provide us with a list of all their non-transaction fee mutual funds or ETFs at their custodian of choice, as if we didn't have the majority of that anyway. But what they'll do is they'll load up a portfolio, or they'll attempt to load up a portfolio with all these different positions just to see what we can do with it. But there's no sense of logic, there's no sense of thought that's been put to it. They've just simply loaded up the strategy with 75 to 100 mutual funds or ETFs. Even on the low side, that may be the case. There was some idiot years ago that loaded up a portfolio with 1,000, 2,000 securities.
That idiot would be talking to you right now.
Yeah, he's on camera right now. So
I actually shut his account off many years ago. I thought he was blowing up the servers, all kinds of stuff was going on. I go, what is this guy doing? I turned his account off so he didn't have any access, and I called him up and said, what are you doing? And he explained it to me. But just in closing minutes here, we've got 2 minutes to go. I think that what we're hoping to get done on this show is a really candid view of what we do and what we're trying to get you folks to do. It's like, what is that one line? Let us help you help yourself, or something like, help me help you. Help me help you. And by doing this stuff, you bring a lot of confusion out of the practice, and some of the things we see, and folks get frustrated, because they're trying to do something it wasn't designed to do, or they have a concept of what they'd like it to do. And the realities is VPM is what it is. It was built, and the philosophies, everything came from myself, and how to make these assets work. And it does a pretty good job under that. And there are some things that you can do to bring in your personality, some of your desires in this, but there's a limitation on some of the things that we see try to be done. And we're just trying to get you to do, let's use it right. I'd say I think I got 1 minute, but I was telling Mitch about this guy when we were kids, and maybe some of the older guys on the call, if there are any. There was this guy named Primitive Pete, and Primitive Pete was actually we found it on YouTube. They used to play it in shop class. It was done by General Motors. It was showing this guy that used every tool possible for, like a screwdriver for a chisel, and he'd ruin his screwdrivers. That's the same thing here. This tool, this process has a very specific way to be used. And when you use it right, it's magic and does amazing things happen with the construction of your practice, scalability, branding, walking your talk, all that stuff. To me, I mean, that's what everybody wants. And there's a way to get there within how we've designed this to do. So we're out of time. So Mitch, you have any closing thoughts, and then we'll move on.
No, I'm really excited about the next conversation, because I know this is an element that gets commonly asked as far as these mutual fund and ETF portfolios, and that's where we're going forward with these.
Yep. So onward we go, folks. Thanks again for all the time and effort that you folks are putting in to watch these things. It's actually hopefully scaling our business from the standpoint of being able to give you guys some really good quality conversations. These are things that we love talking to you about, and we want to help you build your brands and your scalability and do these things in your practice. It's so exciting for me, and I know Mitch has been on board for almost 3 years. Is that what we figured the other day?
Yeah, 3 years as of Saturday.
Yeah, so that's crazy. Okay, and I have a daughter graduating from high school tonight. That's even crazier. So anyway, folks, thanks again. We will talk to you. I guess we won't do another Process Warriors because of the short week until next week. Mitch is actually on the road. It's going to make life a little easier. We'll do a Market Thunder on Friday morning as usual to recap the week. So once again, thanks for everything. We will talk to you soon.